So hi, I'm Judy. So we're gonna talk about the money market. So first, let's answer the question, what is a money market? So what is a money market? It is a securities that is short term and it has a maturity of less than 1 year. So it also includes market of such instruments as bank accounts, including terms, certificate of deposit, interbank loans, money market funds, commercial paper, treasury bills, and security lending and repurchase agreements. So how does it work? So it exists to provide the loans of financial institutions and governments need to carry out their day-to-day operation. So what does money market do? It is a buying or selling of debt instruments in 1 year or less. So also money market investors are extending credit without taking ownership in the borrowing entity or control over management. So who uses the money market? It is the company, banks, and investors. They are the one who uses the money market. So we have also the types of money market instruments. So first we have the commercial paper. So what is commercial paper? It is a short-term debt obligation of a private sector firm or a government-sponsored corporation. So only companies with a good credit ratings issue commercial paper because investors are reluctant to bring the debt of financially compromised companies. Also, commercial paper is unsecured but some are secured by specific asset of investors. So next is the banker's acceptance. So what is the banker's acceptance? It is a negotiable piece of paper that functions like a post-dated checks. These are used by companies as a safe form of payment for large transactions. That is the banker's acceptance. Next is the treasury bills, referred to as T-bills. So these are securities with a maturity of 1 year or less. So treasury bills issued by its own currency are considered as the safest bills of all possible investment in the currency. Next is the government agency notes. So this is a currency note issued by the government. This includes development banks, housing finance corporation, educating lending agencies, and agricultural finance agencies. Next is the local government notes. This is notes issued by the provincial or local governments. Some of the local government notes needs the approval of national authorities, and local agencies also are allowed to borrow only from the bank and cannot enter the money markets. So that is the local government notes. Next is the interbank loans. So what is interbank loans? It is the loans that one bank makes to another. Many of these banks are across international borders. So that is the interbank loans. Lastly is the time deposit, which is very familiar to us, and it is also called as term deposit. So another name also of certificate of deposits or CD. A deposit with a fixed maturity and interest rate. So time deposit cannot be withdrawn before a set or for which notice of withdrawal is required. So that is the types of money markets instruments. So that will be all about money market. I'm gonna introduce to you the capital market, and this is only the introduction about the capital market. So capital market is a long-term debt that has a maturity of 1 year and greater. So capital market securities are bonds, stocks, and mortgage, and the one who uses the capital market are local and national government and corporations. So that will be all of my report, and thank you for listening.
Let's talk about capital market trading. Capital market trading is a trading of financial securities and assets in a capital market. Capital market is an organized financial markets that bring buyers and sellers together to trade stocks, bonds, currencies, and other financial assets. An example of this market here in the Philippines is the Manila Stock Exchange that was established in 1927. Capital market tradings occur in either the primary market or the secondary market. Primary market is where new issues of stock and bonds are introduced. It is a segment of a capital market that deals with the issuance and sales of securities to purchasers directly by the issuer, with the issuer being paid the proceeds. Secondary market, also called as the aftermarket, on the other hand, is the financial market in which previously issued financial instruments such as stocks, bonds, options, and future are bought and sold. It is where investors purchase securities or assets from other investors rather than from issuing companies. The tradings in these markets involve bonds. Now, what is bonds? Bonds are any long-term promissory note issued by the firm. It is an investment securities where an investor lends money to a company for a set period of time in exchange for regular interest payment. The initial or primary sale of corporate bond issues occurs either through a public offering using an investment bank serving as a security underwriter or through a private placement to a small group of investors. Most often, corporate bonds are offered publicly through investment banking firms as underwriting. Firm commitment underwriting is used by investment bank to facilitate these transactions. These are also other arrangements, namely competitive sale, negotiated sale, and best efforts underwriting basis. As of September 2019, these are the bonds issuances by the government, business firms in the Philippines secured by bond funds, and part of the investment portfolio of mutual funds. Some agencies conduct general economic analysis of companies' businesses and analyze firm-specific financial situations. Bond ratings and credit ratings are used. Bond ratings is a way to measure the creditworthiness of a bond, which corresponds to the cost of borrowing of an issuer, while credit rating is a measurement of a person or business entity's ability to repay a financial obligation based on income and past repayment histories. Bond rating is important for a reason that it alerts investors to the quality and stability of the bond. Credit rating also plays a large role in a potential investor's decision as to whether or not to purchase bonds.
Types of bond. First, we have the unsecured long-term bonds. Under this category, we have debentures, subordinate debentures, and income bonds. When we say debentures, these are the unsecured long-term debt and backed by the reputation and financial stability of the corporation. Because this type of bonds is unsecured, the earning ability of the issuing corporation is a great concern to the bondholders. Then subordinate debentures. The claims of the bondholders of subordinate debentures are honored only after the claims of secured debt and as subordinate debentures have been satisfied. The income bonds. The income bonds requires to pay interest only if earned, and non-payment of interest does not lead to bankruptcy. These type of bonds have longer maturity, and unpaid interest is generally allowed to accumulate for some period of time. Another category for types of bond is the secured long-term bonds. Under this category is a mortgage. Mortgage bond is a bond that is secured by a lien on real property. And mortgage bonds can further be subclassified into 6, which are the first mortgage bond, second mortgage bond, blanket or general mortgage bond, open-end mortgage bond, closed-end mortgage bond, and the limited open-end mortgage bonds. Other types of bonds are the following. First, the floating rate or variable rate bonds, in which the interest payment changes with market conditions. Then, junk or low rate bonds. These bonds rated below. Liquidity bonds. These bonds payable or denominated in borrower's currency but sold outside the country of the borrowers, usually by the international syndicate of investment bankers. And lastly, the treasury bond. This bond carries the full faith and credit of the government backing, and the investors consider them the safest fixed income investment in the world. Moving on, let's go to ordinary equity share. Ordinary equity share is a form of long-term equity that represents ownership interest to the firm. Features of ordinary equity shares. First, par value or no par value, meaning the share may be sold with or without par value. It has little significance except for accounting and legal purposes. Next, authorized, issued, and outstanding. Then, no maturity. The ordinary equity has no maturity and is permanent form of long-term financing. Next feature is the voting rights. There are two common systems of voting. First is the majority voting and the other one is the cumulative voting. In majority voting, the shareholder is entitled to vote only for one, and in cumulative voting, the shareholder is entitled to cast multiple votes. Next feature is the book value per share, and lastly is the numerous rights of stockholders.
Now let's talk about valuation. So what is valuation? Valuation is a technique that looks to estimate the current worth of an asset or company. That is the main purpose of equity valuation, to estimate the value of a firm or its security. There are numbers of different ways to perform equity valuation. The most popular methods include but are not limited to the list above. One of the many more popular equity valuation approaches is a parables approach, which is the first one. So parable approach, this strategy evaluates similar companies and compares relevant valuation and metrics. So much for that. Do you know that ordinary or common equity share valuation is complicated by the uncertainty of future returns and/or changes in a share's price? As we all know, ordinary or common equity shareholders are also called as residual owners because their claims to earnings and assets is what remains after satisfying the prior claims of various creditors and preferred shareholders. And speaking of, what is preferred share? So preferred share is a class of equity share which has preference over the ordinary or common equity share in the payment of dividends or in the distribution of corporation assets in the event of liquidation. However, they have no voting privileges. Now let me give you the major features of a preferred share. Number 1, we have par value. Its par value is the face value of the stock certificate. The second feature is dividends. So preferred shareholders' dividends is stated as a percentage of the par value and are commonly fixed and are paid quarterly but not guaranteed. Third, cumulative or non-cumulative dividends. So most preferred shareholders' dividends are mostly cumulative. So if they are not paid in a particular year, they are carried forward to the next years. Unlike non-cumulative, undeclared dividends are lost forever. Number 4, we have no definite maturity date. Because preferred share is usually intended to be permanent, it has no definite maturity date, but it sometimes carries special retirement provisions. Number 5, we have convertible preferred share. It can be converted into an ordinary or common equity share. Number 6, we have voting rights. So a preferred shareholder does not ordinarily carry a voting right. Number 7, we have participating feature of preferred share. So participating preferred shareholder share in profits above and beyond the declared dividends, but most of it are non-participating shareholders. Number 8, we have protective feature. So preferred share issued often contains covenants to assure regular payments of preferred share dividends. Then number 9, we have call provisions. So call provisions give the issuing corporation the right to call in the preferred share for redemption. The last feature, we have maturity. So before, preferred share are perpetual. However, today, most preferred share has a sinking fund as a maturity date. So preferred share has claims against income and assets before ordinary shares, but after death. Moreover, creditors have priority over preferred shareholders in their claims of income and assets. That's why if a preferred share has high risk, investors normally require a higher rate of return. Thus, the intrinsic value of a share of a preferred share is the sum of the present value of future dividend discounted at the investor's required rate of return. This also can be determined using this valuation model here, where PO is the intrinsic value of a share of a preferred share equals DP, which is per share cash dividend, divided by KP, which is the investor's required rate of return on preferred share.